Silver just didn't rise. It sent a message to every investor, every saver, every family trying to protect what they worked for. Because while the headlines scream price rally, the real story is buried in one terrifying question. What happens when the strategic reserve is basically gone and the next delivery window hits? And here's the part nobody is ready for. Some insiders say $135 isn't the target. It's the trigger, meaning the real move may start after $135, not before it. So before you blink, before you scroll, ask yourself this. When silver breaks, will you be holding it or chasing it? The surge that confused the market. Gold, silver, and platinum did not rise quietly. They surged together across futures screens, trading desks, and global exchanges. The move was fast, synchronized, and unusual. Analysts on financial television rushed to explain it. Some blamed inflation fears, others pointed to interest rate expectations, geopolitical tension, or retail speculation. But none of those explanations fully matched what the data was showing, because this was not a normal metals rally. In most cycles, gold moves first, silver follows later, often with more volatility. Platinum usually acts differently, tied more closely to industry than to money. For all three to surge together is rare. It does not happen often. And when it does, history shows it usually means something deeper is happening under the surface of the financial system. This surge confused the market because it broke the usual pattern. If inflation alone were the driver, energy and food would be leading harder. If retail speculation were responsible, social data and options volume would show it clearly. If central bank statements were the cause, currencies would be moving in clearer alignment. But instead, the metals moved as a group while many traditional risk signals remained mixed. To experienced market observers, that combination matters. Precious metals are not only assets, they are signals. They respond to things that are difficult to measure directly: trust, liquidity stress, and confidence in financial structures. When gold rises alone, it often reflects concern about currency stability. When silver joins, it often suggests stress moving into industry and credit. When platinum also moves, it points toward disruption inside the physical economy itself. That is why synchronized strength across all three draws attention. Historically, this kind of behavior has appeared before major transitions. In the late 1960s, metals began rising together as the Bretton Woods system weakened. In the late 1970s, they surged as debt, inflation, and policy credibility broke down. In the years before 2008, gold and silver began climbing long before banks admitted the scale of the problem. In 2220, metals moved before supply chains froze and central banks unleashed emergency liquidity. In each case, the surge was not the event, it was the warning. What made the current surge different was not only the price movement, it was the timing. It came at a moment when global debt is at historic levels, when government deficits are structural, not temporary, and when central banks are quietly changing the way reserves are managed. It also arrived as supply chains remain fragile. Energy systems are being redesigned, and geopolitical trade lines are being redrawn. Under such conditions, markets rarely give clear signals. They give layered ones. To understand why gold, silver, and platinum move together, one must look beyond charts and headlines. The key is not what investors are saying. The key is what large institutions are doing. Sovereign buyers, industrial users, refiners, and long-term holders often act long before the public narrative adjusts. Their movements tend to show up first in physical markets and in metals, because metals sit at the intersection of money and material. Gold remains a monetary reserve. Central banks hold it not for yield, but for independence. Silver is both monetary and industrial. It sits inside electronics, energy systems, and medical supply chains. Platinum is deeply industrial, tied to emission systems, chemical processes, and emerging hydrogen technologies. When all three strengthen at once, it suggests stress in both financial confidence and physical supply structures. This is why surface explanations fail. If this surge were only about inflation, it would track consumer prices more closely. If it were only about war headlines, it would spike and fade. If it were only about speculation, positioning data would show extreme crowding. Instead, the move developed alongside subtle changes in liquidity conditions, funding markets, and cross-border flows. It began while many equity markets were still calm. That matters because metals often move before recognition. They respond not to official announcements, but to strain. They move when settlement systems tighten, when collateral becomes scarce, and when confidence in paper claims weakens. They tend to rise when institutions quietly rebalance away from promises and toward assets that do not depend on counterparties. In that sense, metals do not celebrate. They prepare. Observers who focused only on price missed the message. The more important story was structure. Futures curves were shifting. Physical premiums were becoming less stable. Inventory reports were showing uneven flows. None of this appeared dramatic on its own, but together they formed a pattern of growing tension between financial claims and physical reality. Markets are built on confidence. They assume that liquidity will always appear, that settlement will always function, that supply will always be sourced, and that debt can always be rolled. When those assumptions begin to weaken, even slightly, the first assets to reflect it are often precious metals. Because metals are not promises, they are final assets. They do not require performance from anyone else. They do not depend on yield, policy, or growth forecasts. They simply exist. For centuries, that is why they have acted as the quiet refuge when systems reorganize. This surge, therefore, was not enthusiasm, it was positioning. It suggested that some participants were no longer looking at the world as stable. They were no longer assuming that existing monetary arrangements would hold without strain. They were not waiting for confirmation. They were adjusting before disruption became obvious. That is what confused the market. The move did not match the story being told, and when price behavior separates from narrative, the behavior deserves more attention than the story. Part 1 establishes the essential point. Gold, silver, and platinum did not rise because of a single headline. They rose together because conditions underneath global finance and industry began to shift at the same time. That alignment is rare, and when it appears, it usually precedes broader recognition. The critical question, then, is not how far prices can go in the short term. The critical question is what forces are strong enough to move all monetary metals at once. That question leads beyond charts. It leads into liquidity, institutional behavior, and the structure of the modern financial system itself. And that is where the real explanation begins. What the market wasn't being told. If Part 1 revealed that the surge was not normal, Part 2 exposes why it was happening in the first place. Behind the screens, away from financial television and daily headlines, a quieter shift was unfolding. It was not emotional, it was not speculative, and it was not driven by the public. It was institutional. Large actors were moving, not in a way that creates noise, but in a way that creates pressure. The kind of pressure that slowly builds inside systems before it suddenly becomes visible. Because the global financial system is not moved by opinions. It is moved by liquidity. Liquidity is not money. It is the ability to settle, the ability to roll debt, the ability to deliver, and most importantly, the ability to trust that someone else can perform when required. Over the past several years, that ability has quietly weakened. Governments around the world have issued record levels of debt, not to invest, but to sustain. Deficits have become permanent. Central banks have expanded balance sheets, contracted them, and expanded them again. New lending facilities have been built, old ones have been reopened, emergency tools have become standing tools. To the public, this looks like management. To institutions, it looks like strain. When debt grows faster than productivity, liquidity must constantly be manufactured. When liquidity must constantly be manufactured, its credibility erodes. And when credibility erodes, large capital does not wait for collapse. It relocates. That relocation rarely starts in headlines. It starts in reserves. Over the last decade, central banks have been quietly changing the composition of what they hold. Gold has been returning to balance sheets at a pace not seen in generations. This was not a political statement. It was a structural one. Gold does not default. It does not freeze. It does not require counterparties. It sits outside the credit system. But what made the current moment different was not only gold. Silver and platinum began moving with it. That is where the signal deepens. Silver is not only money, it is infrastructure. It sits inside electronics, energy systems, medical equipment, and industrial automation. Platinum is not decorative, it is functional. It sits inside chemical processing, emissions control, refining, and emerging hydrogen systems. When these metals rise together with gold, it suggests that concerns are no longer limited to currencies. They are spreading into supply chains. This is where most surface analysis fails. Market commentary tends to separate finance from industry, but modern economies do not function that way. Financial systems are layered on top of physical systems. When stress appears in funding markets, it eventually shows up in production. When production tightens, it feeds back into finance. The metals complex sits exactly at that intersection. And at that intersection, something was shifting. Physical supply was becoming harder to source on predictable terms. Refining capacity was under pressure. Mining investment had lagged for years. Inventories were thinner than official reports suggested. At the same time, industrial demand was not slowing. It was becoming more technologically concentrated. Energy transition projects, electrification, automation, and medical expansion all rely on silver. Emission systems, chemical plants, and new fuel technologies rely on platinum. These are not optional inputs. They are embedded ones. That meant the surge was not driven by fear. It was driven by necessity. Institutions were not reacting to price. They were reacting to reliability. When reliability comes into question, metals stop behaving like commodities and start behaving like reserves. They move from just-in-time assets to just-in-case assets. This shift rarely announces itself. It expresses itself through premiums, leasing conditions, delivery timing, and cross-border flows. It appears first in procurement behavior, then in inventory policy. Only later does it fully surface in price. By the time price moves clearly, positioning has already changed. This is what made the surge powerful. It was not sharp because of excitement, it was steady because of adjustment. At the same time, another factor was building beneath the surface: leverage. Modern metals markets are not primarily physical, they are primarily contractual. Claims are traded many times over each ounce of underlying supply. Most participants do not intend to take delivery, they intend to settle financially. This works only as long as settlement confidence remains absolute. When confidence weakens, even slightly, the balance between claims and metal matters. Leasing tightens, forward curves distort. Inventories begin to behave unpredictably. The system still functions, but with growing internal tension. That tension expresses itself as synchronized strength. Gold reflects the monetary side of the tension. Silver reflects the hybrid side. Platinum reflects the industrial side. Together, they map the entire structure of the economy. Their joint movement, therefore, signals something larger than a trade. It signals a realignment of risk. At the same time, geopolitical trade patterns were changing. More nations were settling outside traditional currency pathways. Strategic stockpiling was quietly increasing. Resource nationalism was returning. Export controls were becoming tools of policy. All of this reduces the assumption that materials will always be available through markets alone. When that assumption weakens, buyers move earlier. They lengthen supply chains. They increase buffers. They hold more than they need. That behavior does not show up as panic. It shows up as sustained accumulation. And sustained accumulation is exactly what supports long, quiet surges. This is why the rally did not collapse after its first move. It did not need headlines to survive. It was being fed by positioning that was already in progress. To outside observers, the surge looked sudden. To insiders, it was overdue. This is the uncomfortable truth of system transitions. They are not announced, they are built. They move invisibly through logistics, reserves, contracts, and planning documents long before they reach news tickers. The metals market is often where those invisible adjustments first become visible. Because metals sit outside policy, they cannot be printed, they cannot be negotiated, they can only be sourced, refined, and delivered. When access to those processes becomes strategically important, price stops reflecting emotion and starts reflecting structure. That is what gave the surge its power. It was not about what traders expected. It was about what institutions were no longer willing to assume. And when assumptions change, markets follow. But the most dangerous part of this shift is not demand, it is fragility. Because a system built on leverage remains stable only while confidence remains unquestioned. When physical constraints meet financial claims, the stress does not dissipate, it concentrates. And that concentration does not release slowly, it releases when something fails. Part 2 shows that the surge was not driven by fear or speculation, but by deep changes in liquidity, supply reliability, and institutional behavior. Part 3 will go further, because beneath these shifts lies a structural fracture between paper markets and physical reality. And fractures, once formed, do not heal quietly. The fracture beneath the surface. By the time gold, silver, and platinum began surging together, the most important change had already happened. The system had started to strain, not publicly, not dramatically, but internally, in the places most people never look. In inventory reports, delivery schedules, lease markets, and refining capacity, in the quiet mechanics that allow a global metals market to function. Because modern markets are not built on metal, they are built on promises. For every ounce that exists, there are many claims. Futures, options, swaps, unallocated accounts, exchange-traded products, leasing contracts, and industrial hedges all represent metal that may never move. Most of the time, it does not need to. Positions are rolled, accounts are settled in cash, exposure is transferred without touching a bar. The system works only under one condition. That physical delivery remains an assumption, not a demand. The moment that assumption weakens, even slightly, leverage stops being efficient and starts being dangerous. That is where the fracture begins. For years, the precious metals complex functioned on excess capacity. Mines could expand, scrap could return, vaults were assumed full, logistics were predictable. That allowed paper markets to grow far larger than physical trade. It also encouraged years of underinvestment in extraction, refining, and reserve development. That underinvestment is now visible. Ore grades have been declining across major mining regions. New projects take longer to permit, finance, and build. Energy costs have risen. Environmental constraints have tightened. Capital has favored technology and finance over materials. As a result, replacement supply has lagged depletion. At the same time, demand has not weakened, it has shifted. Silver has become a structural input for electrification, solar generation, medical equipment, and automation. Platinum remains critical for chemical processes, industrial catalysts, and emerging fuel technologies. These uses do not respond to price in the short term. They respond to engineering necessity. When necessity meets constrained supply, pricing power changes. But price is not the first thing that breaks. Settlement is. As physical buffers thin, the market relies more heavily on rolling contracts forward. This increases dependence on leasing and rehypothecation. Metal that is spoken for once becomes spoken for many times. The system remains stable only as long as delivery remains rare. However, subtle signs have been accumulating. Leasing conditions have become more volatile. Forward curves have distorted. Some inventories have moved in unexpected ways. Physical premiums have separated from futures pricing. Regional availability has diverged. Each signal alone could be dismissed. Together they form a pattern. They indicate a growing distance between what is traded and what is available. This distance is not measured in headlines. It is measured in delivery friction. When friction increases, large users adapt. They do not wait for exchanges to acknowledge shortages. They lengthen procurement horizons. They seek direct relationships. They secure supply before it is advertised as scarce. This behavior quietly drains flexibility from the system. Less flexible systems break more suddenly. This is why the surge matters. It suggests that some participants are no longer comfortable relying on continuous rollover. They are beginning to treat metals as strategic resources rather than financial instruments. That is a fundamental shift, because strategic resources are not optimized. They are protected. Protection requires possession, and possession removes material from circulation. When enough material is removed from circulation, leverage becomes visible. The modern metals market is not designed for widespread delivery. It is designed for price discovery and hedging. Physical movement exists to support it, not define it. When too many participants move from hedging to holding, the architecture becomes stressed. This stress does not show up as empty vaults overnight. It shows up as scheduling delays, increased premiums, shifting contract terms, and sudden rule changes. It shows up as incentives to settle financially rather than physically. It shows up as rising costs to secure what was once routine. It also shows up as synchronized strength, because when physical confidence weakens, all metals reprice together. Gold reflects confidence in money. Silver reflects confidence in production systems. Platinum reflects confidence in industrial continuity. When all three are questioned, all three move. This is why the current surge carries more suspense than excitement. It is not signaling opportunity. It is signaling adjustment under pressure. Another dimension deepens the fracture, concentration. Platinum supply is geographically narrow. Silver production is often secondary, dependent on the economics of other metals. Gold mining faces long development timelines and declining discoveries. This creates asymmetry. Supply cannot respond quickly, but financial claims can. They expand without friction. This mismatch between speed of claims and speed of supply is what builds structural instability. It allows markets to appear liquid while becoming fragile. It allows pricing systems to function until suddenly they cannot. Historically, when this mismatch becomes too large, resolution follows one of two paths. Either price rises to ration demand and attract capital, or settlement rules change to protect intermediaries, sometimes both. The surge suggests the first process has begun, but the second always follows when the first is not enough. This is why synchronized metal strength deserves attention from decision makers. It implies that the system is moving from abundance to constraint, from optimization to security, from confidence to verification. Verification changes everything. When participants want to verify ownership, chains tighten. When chains tighten, flexibility vanishes. When flexibility vanishes, volatility rises. And volatility in a leveraged system does not dissipate. It migrates from commodities into credit, from credit into currencies, from currencies into institutions. Metals are often where that migration begins, because metals are where physical reality meets financial abstraction. The current surge, therefore, should not be read as enthusiasm for metals. It should be read as diminishing enthusiasm for assumptions. Assumptions about endless liquidity, assumptions about infinite sourcing, assumptions about frictionless settlement. As those assumptions weaken, participants do not wait for validation. They act. And when enough of them act quietly, markets eventually move loudly. Part 3 establishes the fault line, a growing separation between paper structures and physical constraints, a leverage system encountering material limits, a market architecture built for stability entering a phase of tension. Part 4 will address what this means, because when such fractures form, the consequences do not stay inside commodity markets. They spread into capital strategy, corporate planning, and long-term economic positioning. And once they spread, ignoring them becomes far more expensive than studying them. The strategic meaning of the surge. By the time gold, silver, and platinum rise together, the market is no longer speaking in prices. It is speaking in warnings. Because synchronized strength across monetary and industrial metals does not describe a trade. It describes a shift in how risk is being measured. In stable systems, capital seeks return. It tolerates leverage. It stretches duration. It optimizes for yield. In stressed systems, capital seeks survivability. It shortens exposure. It favors tangibility. It moves away from structures that depend on constant confidence. Metals belong to the second world. They are not growth instruments. They are system instruments. When institutions move toward them together, it suggests a reassessment of the environment itself. This is what makes the current surge strategically important. It is not reacting to one policy decision or one economic report. It is aligning with a broader recognition that the global system is entering a phase where reliability matters more than efficiency. For decision makers, this matters because economic regimes change quietly before they change publicly. The transition from the post-war gold standard to the fiat era began years before 1971. The debt supercycle was visible before 2008. The monetary emergency that followed 2020 was already embedded in balance sheets long before it appeared in headlines. In each case, metals moved first. They did not predict events. They reflected positioning. Positioning toward metals indicates a belief that certain assumptions are weakening, that liquidity will always be abundant, that funding markets will always function smoothly, that political coordination will always stabilize disruptions, that supply chains will remain globally frictionless. As these assumptions weaken, strategy changes. For corporations, this means reassessing procurement and treasury structures. Metals' strength often precedes rising input volatility, longer lead times, and greater dependence on secured sourcing. It suggests that supply resilience may soon cost more than it has. For financial institutions, it signals that collateral dynamics may change. When physical assets regain monetary relevance, balance sheet behavior shifts. Duration risk is repriced. Counterparty exposure is re-examined. Settlement structures face new scrutiny. For long-term investors, synchronized metal strength warns that traditional diversification may no longer function as expected. When metals rise together, it often means that correlations across asset classes are in the process of reorganizing. For entrepreneurs and builders, it implies that the economic environment may become less forgiving of leverage and more rewarding of control. Control over inputs, control over financing, control over time horizons. This is not speculation. It is pattern recognition. In every major economic transition, a period appears when materials outperform narratives, when supply matters more than sentiment, when possession begins to matter more than promises. That is the phase metals typically mark. The surge, therefore, should not be read as opportunity alone. It should be read as preparation. It suggests that capital is beginning to favor assets that do not require explanation, assets that do not depend on refinancing, assets that do not function on confidence. That preference changes the behavior of entire systems. As metals strengthen, the opportunity cost of holding them falls. As the opportunity cost falls, institutional resistance weakens. As resistance weakens, participation broadens. When participation broadens, structural pressure intensifies. This is how monetary transitions build, not through announcements, through reweighting, through quiet shifts in reserves, inventories, and long-term contracts, through the gradual acceptance that the previous environment no longer offers the same guarantees. The danger for observers is misinterpretation. Price surges are often treated as noise, but when the composition of a surge changes, its meaning changes. A gold rally can be dismissed. A gold, silver, and platinum rally cannot. It touches money, manufacturing, and material science at once. It reflects both financial and physical recalibration. It indicates that the economy is being evaluated not on growth projections, but on endurance. That evaluation reshapes everything downstream. Credit becomes more selective. Projects become more capital intensive. Timelines extend. Risk premiums rise. Margins compress. At the same time, strategic assets gain weight, not because they promise returns, but because they reduce vulnerability. This is why metals historically perform best not in booms, but in transitions. They are not beneficiaries of expansion. They are witnesses to reorganization. The present surge implies that such a reorganization may be beginning. It suggests that the system is shifting from an era of monetary experimentation to one of monetary consequence, from an era of financial engineering to one of material constraint, from an era where perception drove pricing to one where delivery will. These transitions are not linear. They unfold unevenly. They produce volatility, policy responses, and narrative conflict. But beneath that surface, they always express the same underlying movement, from abstraction back toward reality. Gold, silver, and platinum are realities. They cannot be deferred. They cannot be diluted. They cannot be printed. They must be mined, refined, stored, and moved. When capital moves toward such assets simultaneously, it is not chasing. It is repositioning. And repositioning always occurs before repricing becomes universal. Part 4 concludes the core warning. The surge in precious metals is not a story about commodities. It is a story about system trust. It is not a comment on short-term direction. It is a comment on long-term architecture. And when architecture begins to change, those who recognize it early do not trade. They adapt. Because in periods of structural transition, the greatest risk is not volatility. It is assuming the old environment still exists,